Hi, everyone. Welcome to the 141st episode of the Timing Research Show for June 12th, 2017. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be talking about the 194th weekly report. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com and you can download this or any of the past reports there. I'm Matt Buckley back to host today, so I'm going to go ahead and turn it over to him.
All right, David, thanks for having me back. I appreciate it. We got a great lineup for this week, as usual, and a lot to talk about. I mean, geez, we have an attorney general testifying tomorrow. We got a tech wreck going on. We have a VIX that's just starting to wake up after being asleep for so long. So we have a lot to talk about, and we're going to keep us on time and on schedule. That's my job. So we have Kurt Capra from T3 Live, Fausto Pugliese from CTU, that's Cyber Trading University, John Netto from the Protean Trader, and Simon Klein from Trade Smart Forex. So guys, let's keep that same batting order as we go through our discussion today. So we'll kick it off with you, Kurt. Give us a quick executive summary of your background and how you got to where you are today.
All right, well, thanks for having me back, of course. So I started mainly just focused on futures exclusively. Index futures, not really much of anything else. And that was at a time when you could really focus in on just trading the market. It was moving enough, it was volatile enough to where that could be your bread and butter. But then as volatility started to contract, that really wasn't so much the case anymore, and started at that point to venture out into other things, ETFs, Forex, a little bit of equities here and there. But that's pretty much where I am at now in where my focus is. So, as I said, been in and around a little bit of everything over the years, and throughout that entire time really focused on the same method, using the same approach that entire time as well.
Awesome, Kurt. Okay, welcome aboard. And Fausto, good to work with you again, my brother. Give us a quick executive summary about your background and what you do with CTU.
Well, thanks for having me back again, and it's always great to talk to everyone from Timing Research. Just a little bit about me. Been doing this for over about 23 years now, and never get tired of it because everything's so exciting. I'm one of the original SOS bandits, original day traders that helped pioneer a lot of the ECNs that were built today, a lot of the platforms. I run an online educational school where we train hundreds of thousands of people around the world, and also we run a professional trading room where our students actually trade together and work to the team with our staff. So we kind of do a little bit of both. And I basically train my students how to trade the market, specifically how to day trade, which will lead into if anyone needs to know about swing trading or options trading. But understanding what's happening over the course of the day is what I kind of focus on. And I think a lot has to do because I like to sleep at night. That's probably the only reason why. But that's my story. And like I said, I'm also the author of the book, How to Beat Market Makers at Their Own Game.
Awesome, Fausto. And John, talk to us about your background and what you do with the Protean Trader.
Sure, it's great to be here. I'm a cross asset class trader. I make all my money from my trading P&L. I wrote a book called The Global Macro Edge: Maximizing Return Punitive Risk. Every dollar made from that has gone to pay to charities which train and place service dogs with military veterans. I'm big on the macro narrative. I'm big on incorporating the quantitative and the qualitative. I'm big on incorporating my instincts into the markets. Like I say, every dollar that I've supported myself and my family with has all come from my trading P&L for many, many years now. So I look at everything from perspective of return punitive risk. I spent close to 9 years in the U.S. Marine Corps, from right out of high school to when I was 27. I was a liquidity provider in high school. I was for those wishing to prognosticate on the outcome of sporting events. And so this idea of taking on risk from a very young age, whether it be speculating on a sporting event, a market, a Fed policy decisions we have coming up here on Wednesday, it's always been something very natural to me. And so without it's pretty obvious to understand that why I would live in Las Vegas, Nevada, a town that truly appreciates the art of speculation. And it's just great to be here.
Awesome, my friend. Well, Semper Fi. And finally, Ben, clean up here. Simon, give us a little bit about your background and what you do with Trade Smart Forex.
Oh, hi. And Thank you for having me back again, David. It's a pleasure to be here. I started my professional life actually straight out of university working for Credit Suisse in both London and New York. I actually started on the computer side of things. And then I was very fascinated with the trading floor and ended up moving to the trading floor eventually. And then I worked for a number of other trading firms after that. And then I decided about a number of years ago to start my own. And the idea was to give traders what I felt they were missing in their education, to give them a solid foundation. So the way we train our traders is to start them from the technical side of learning how to read the markets, and then moving them on to actually teaching them the second part of how to run a trading business, so they know the whole framework that needs to go into place. And then finally, we work one-on-one with each one of them to develop a trading plan that fits their personality and lifestyle. So, and we'll keep working until we find one. And eventually, at the end of that training, they walk out with a strategy and a trading plan that actually has a positive expectancy that they can go out into the market and actually make money consistently. That's the plan of the program. So that's what we're doing here at TradeSmart Forex.
Awesome, Simon. All right, guys, let's go ahead and get airborne. Let's go ahead and combine questions 1 and 2, and it's interesting to kick off with these right now. With the which direction you think the S&P is going to move from today's open, and we're starting to see a little bit of the post tin sandwich lunch, Chicago and New York sell-off here might pick up a little bit of speed, so we'll see. But questions 1 and 2. So where are we going to close relative to today's open on Friday? And give us your confidence. And then as we do all those, we'll go ahead and bad cleanup and see why you exactly feel that way. So Kurt, why don't you lead off?
All right. So obviously we had the sell-off in tech heavy on Friday, rotation into financials and some of those areas that had been weaker. So that it's been real interesting to see. With that being said, you've already mentioned we're seeing some additional weakness here today. We've got the Fed coming up on Wednesday. So just based purely on the trend, we're up. So that would suggest that we move higher. But I think here in the short term, if we're talking between today into Friday's close, I'm going to say that we're a bit lower. I don't think it's a significant amount, but I do think we pull back in a little bit more here before then ultimately pushing back up probably some point, next week. And as far as confidence, I mean, it's one of those things where with regard to the technicals, I am 100% confident until something changes to tell me otherwise. So I think you're muted right now, actually.
Yeah, I was talking to myself. There you go. That's a pretty high confidence level. You're not going to go 110, right?
If you gave me the option, I might.
All right. Well, Kurt's 100% higher by Friday. I got that. Fausto, over to you, my friend.
Well, since the last time we were on, I mean, it's been a while, but market's been doing great. I was very bullish on the market, especially after what happened with the November election, with two totally different, two different agendas and two different presidencies coming in, which is kind of, you could see how the market has been up almost like, I think with the Nasdaq's up like 20% overall. But with the S&P, seeing what's happening at the end of the week, I mean, now you're seeing all these investigations coming into fruition. I think a lot of people are depending on what's going to happen with the see if the president's going to get his tax cuts and everything like that, or you could see a real big correction, I think, in the market. I mean, they're really, really factoring it in. A lot of people that are listening right now are probably really happy what's going on with their IRAs right now. Not to get political. I'm not doing that. I'm a trader. I'm a trader first, looking at it. And, if you're happy with that, and these things come to fruition regarding about these tax breaks, I can see the market, probably going to 25,000, but seeing what's happening right now overall, you're going to get profit taking. I mean, listen, at the beginning of May, we were at 23, 2000, was it the 350. We're up almost 100 points from them. That's a lot, you know. Since February, we were just 100 points lower than that. So we had a huge rally. You're gonna have profit taking going across. So listen, it's normal. It's healthy. You want profit taking. So, but look at over the long picture. You know, as long as we don't have any big catastrophes coming up, you know, over long term, I think it's going to be a lot higher.
All right, man. You're not going to hear too many arguments from me. So, John, how do you think we close on Friday relative to today's open, and how confident are you?
Lower, modestly confident. We have the Fed on Wednesday. The language that comes from them in terms of their balance sheet reduction, and some of the second-tier economic data with CPI, what we get out of Europe with the zoo survey, and ultimately retail sales for May is going to determine whether this economic weakness that we see as the Fed annotated is transitory or not. And so, I mean, the language is going to determine it all. And so the real question we should almost be asking ourselves is not where you see the S&P going, but like, what do you see coming from the Fed? Because that, in essence, I think is going to tell us how the market then has to reposition itself. And so for me, I think we're modestly lower, and I have a modest confidence interval in that.
All right. So, whoa, that's a little loud on the speaker there. Simon, how about you?
Okay, I would say probably going lower this week, and potentially we'll pick up the trend, the weekly uptrend actually, and continue higher. But we may have, this week looks like we may end up closing lower. Doesn't mean we're going to, but that's what it looks like at the moment. And I would say 50%.
All right, we got a 50 delta. There's a coin flip, which you know, sometimes it really is. The S&P coming a little bit off its lows right now, but I say we're higher. I put on a weekly options bull put spread. I sent out to my members a little while ago around the 2410 level, which is where we plateaued. I'll show my chart in a little bit. So I think we're higher by Friday, and I never squeeze a trigger on a missile in flight or anything. You know, capital-wise, without being around 100% positive, because why would you take that shot? So now let's get into the reasons. So Kurt, we'll start with you, my friend. Give us some of the Ouija board stuff you're looking at this week for your decision on where the market's going to go by Friday.
Like I said before, I mean, it's really just purely based on technicals, and I actually said I think it'll be a bit lower here first, and then higher, you know, maybe by some point next week. So obviously we've got the Fed that's going to generate some uncertainty. You see things like TLT, which has been pushing up. So, you know, bonds have been pushing up, which is another factor that might suggest there's fear that's starting to, or has been creeping into the markets here, at least short term. Gold had been moving up as well, although it did pull back last week, trying to push up a bit here this week with FOMC on tap. So those are some of the, you know, the things I'm looking at in terms of expecting a bit of a pullback. But like I said, I don't think it's going to be anything all that severe ultimately, as it appears more of a rotation type of scenario where, you know, tech has been so strong, so it's obviously gotten hit a lot harder. But you've also got the small caps, Russell IWM, which has been showing relative strength here recently, which is a nice sign, along with transportation names as well. So those are the things I'm looking at to say short term here. I think, you know, we correct a bit, but not anything too significant.
All right, there's some good stuff in there. Fausto, what are you seeing tactically on the flight schedule for the week to support your where you think we're heading?
Well, I think we're probably going to be heading just, you know, probably on a flat market. I mean, I don't know about where you are, but it is awfully hot here in New York. I think the weather finally broke. So with that happening, you know, obviously going into the summer times, a lot of people start going away. People start using their houses in the Hamptons. I don't think there's going to be that much action going on unless something happens with the Fed. I know that I saw a lot of the retailers coming out with some good news. You saw the rumor of Nordstrom's considering buying back their whole company and not being public anymore. So that's obviously a really good sign. But overall, I think, like I answer my last question, I think we're going to probably end up closing probably flat, probably higher where we are right now. You're just seeing a little profit taking going on coming back from the weekend. We got the whole Comey thing that was taken care of last week. I mean, I did an event on Thursday, and we didn't have that many people because obviously everybody was watching the whole thing that's going on TV. So we'll see what happens tomorrow with Jeff Sessions, and then hopefully people will start taking trading a little bit more responsible. But as technical goes, I think the volume is going to be pretty light. We'll see what happens going until next week.
Yeah, there's a lot of good stuff. Fausto, if you think it's hot up in New York, try being down here in Boca Raton, Florida. It's a little, you walk outside and you melt, man, down here in God's waiting room. John, how about you on your tactical radar for the week? What are you seeing that's going to drive this market higher or lower?
Sure. I'm a big numbers guy. I talked about, using my instincts, but I built this unit of risk process, which breaks down things from both the macro narrative and also just digesting, what's driving the trade. And we talked a little bit about some of the Trump challenges, and I think it is worth noting that the worst thing, and this hasn't got a whole lot of attention, but that happened to Donald Trump last week, goes by the name of a guy by the name of Michael Dreeben. He's well respected, he's maybe regarded as the single best criminal appellate attorney, and he was retained by Robert Mueller last week. And the reality is, when someone like that comes on board to a case, and I think I think Fausto mentioned earlier about some of the Trump stuff, but to follow up on that, I think some of the price action today is the acknowledgement of Dreeben's presence to possibly form up a criminal investigation. And that kind of took on a pretty serious turn. Like that's a heavyweight that Donald Trump doesn't want going against him. Again, not being political, but taking an objective assessment of where the market's at. The second thing, getting back to my numbers quote, is that, listen, the FANG index obviously led the NASDAQ lower and it's rippled, but let's just do some quick math here. If Facebook, Amazon, Apple, Netflix, and Alphabet / Google are down 10%, the energy sector, industrials, would need to rally 4.5% just for the S&P to be flat, okay? And this is a dynamic of just the indexing that goes on between what the XLK comprises in the S&P 500. So I think that the NASDAQ is, as we're seeing right now, prone to a sell-off, and just the weight of those components of a 10% of an overall 10% sell-off just makes it very difficult for the S&P 500, given what I just talked about. Now, we saw a big draw in crude last week, one of the biggest draws collectively between not only crude oil, but the products, the heating oil and the gasoline. And so if you're going to say that energy is going to come off the lows with that kind of supply sitting out there, if you think that the banks, with what's perceived to be the financial sector, which would also have to make up that slack from the technology, is going to make a comeback with the Fed this week, which is many people regard, and I think as well, is quite possibly going to be done. I think if they don't provide any balance sheet language for later on in the year, there's a sense that, and we have retail sales and inflation, which could also disappoint. I've seen some stuff there. So I think a possibility with weakening in financials, no steep yield curve, they borrow short and lend long. That's the whole financial model right there. That's a lot of it. That's not in play. And the inability of the rest of the S&P to overcome this tech weakness makes it very difficult for me mathematically to quantify why the S&P would be higher this week. And that's, I'm a numbers guy, process driven. I take a lot of inputs from the ecosystem, both qualitatively and quantitatively, and the overhang and this very subtle acquisition of Dreeben coming onto the prosecution side, at least on a part-time basis, and given some of the commodity overhang reemerging, and given the weakening Fed, which is bad for financials, I think it's hard for the S&P to close higher, but it is a technical uptrend, which is why I think it's going to be lower, and I have a modest confidence in everyone. Now, if we get more hawkish language from the Fed this week, and we get a perception that the market is slowing, the economy is slowing down, that to me becomes very compelling to become even more bearish, because now we have a Fed policy mistake at play. And if the Fed, and I talk about all this in my book, how I come up with all this stuff, but if we start dealing with the Fed policy mistake, the market's not pricing that in. So to me, when I said earlier, really you're asking the question of, not where we think the S&P will be this week, but what's coming from the Fed. So if you think the Fed is going to stay on course and not back off, and still leave the market with the impression that a rate hike is going to come later on this year, and that's the case, the market taking into account some things I just mentioned could actually head down, could head much further lower. If, however, the Fed gives us every inclination that they are done, and that they're still going to wait and see for any kind of balance sheet reduction, it may not be till 2018. I think the market can come back and recover a little bit but not too much. And I still think the chance that they still close modestly lower. So to me, it's all about Wednesday and having that game plan for a very qualitative one-off event. And the things like this Fed on Wednesday, this is where quants begin to struggle, and why the global macro narrative and why the global macro wedge is so important, because you can't go and back model this one-off event coming this Wednesday. You can't model, what Fed language comes out and how the market should react. You just have to know it. You have to be on top of it. You have to have your fingertip on the pulse of things. So that's what I do, and that's how I'm setting up for it.
Yeah, it's interesting because I think Goldman Sachs came out with a note today that said the rate's going to go, or the Fed's going to raise 25 bips on Wednesday. And last week they had said they had punted back a rate increase from September to December. So you got to love the Death Star when they're like 1 week they're saying that, and then immediately next week they're the Fed's going to raise rates this week. And
the rate hike this week is largely priced in. I mean, it's a 90% probability. So Goldman saying they're going to raise on Wednesday is no shock to anyone. I think the real shock, the real torch, is if the Fed, let's say we do get a weak CPI number Wednesday morning, which we had a miss in inflation for the April data, which came out in May. If we get a miss for the May data, which now comes out in June, you're looking at, people, and for some reason retail sales, lays a bomb. The Atlanta GDP now forecast and the New York GDP now forecast has been coming down. They initially started like 3.8%. I think it's down to 2.6%. So the retail sales has what's called the retail sales control group, which makes up a big input in that GDP number. So if the May retail sales number misses, you already have 2 months of Q2, which is in the bag, and we may not quite get that recovery. So, they may start chirping a little bit. Will the Fed even hike at all? Now, again, there's a 90% probability, but if we don't hike on Wednesday, we're done. The Fed's never hiking again. Risk probably comes back on again. Emerging markets come back on again. The yield curve flattens for sure. We're going to get a huge rally in the belly of the yield curve and go from there. So again, I can't emphasize enough, you got to have done your homework for this Fed meeting, because it's going to determine the macro narrative, which then determines what technical systems you want to put into play.
I'd agree with all that, John. Very. Simon, how about you? What's on your radar for the week?
Oh, hi. I'm wondering if you can all see my screen, if that's okay. Can you see my screen?
You bet.
Okay, that's great. So the decision-making process for me is purely based on charts. I believe, as a pure technician, I think I was actually in New York not so long ago, and a few months ago, and I was speaking to some friends of mine, some fundamental friends, and they said technicals is fundamentals. And that was the first time I heard that. I always thought that technicals and there's fundamentals, and some people merge the two. So it was very interesting when he turned around to me and he said, and he, speaks regularly on CNBC and various other news programs. And he said to me, technicals is fundamentals. That's what he said. So if I look at the charts, my decisions are based primarily on the charts, because I know that the charts will show me the footprints of money, of where money is actually moving. Now, from a pure technical point of view, as a trader, you don't really need to know why, you need to know what. So if I look at the charts here, if we just make it big, if I look at the monthly chart, we're uptrending. So if you're in a trend, assume it's going to continue until it ends, yeah? And we don't have any previous highs, because we're just making new highs. So that's if we look at the monthly chart. If we go down and look at the weekly chart, again, we're uptrending here, making higher highs and higher lows. That's why I say we may get a pullback here, but maybe we're going to continue higher. So again, you're not going to know until it plays out. I make decisions as the market plays out. Call it being mindful, being in the moment, having your finger on the pulse of the market as it's happening, so you can adjust and change. You can be trading on the long side, and if the market tells you now it's going down, you have to change. So that's basically on the weekly chart. But if we look at the daily chart, this is where it gets interesting. And at the moment, we're moving up, but this bar changes everything, because we were kind of uptrending until then, and we actually went below this pivot low here, over here. But we also went above the highs, yeah? And now we're kind of coming down. Look where we stopped. We stopped in this, what I call demand zone. This is where prices rose, where there's an imbalance between buy orders and sell orders. There's more willing buyers here, hence we pushed up. So the question here is, which way are we going to go? We broke the uptrend on this time frame, but we're still uptrending on the weekly and monthly charts. So are the weekly and monthly charts going to pull this around and, like a magnet, so to say, and it continues the uptrend? Or is this going to pull down the weekly and monthly charts to actually change, to actually start moving on the downside. So that's a question. Is it a top-down analysis? Are the bigger time frames going to have effect on the smaller time frames, or is the smaller time frames going to affect the way the bigger time frames are going to end up? Again, you need to do a bit of both. So at the moment, that's what I said. If we actually go above these highs and close above, then we're probably going to go higher. We're going to continue the trend to the upside. If we stay within this bar, we're probably going to chop around sideways. If we go below this area, we're probably going to go to the downside. So that's what I'm looking at. So what's it going to do? I've got no idea until it does it. And once it does one of those things, I know what I'm doing. So in the meantime, it's probably going to chop around. And since we broke the uptrend, we're likely to move maybe to the downside. But if you can see, if we look at the lower time frames like today, let's look at the hourly chart, we can see this is exactly what's happening. We're going up and down, down, up, until, and to trade this on the smaller time frames, I'd say the same thing. If we go above these highs, we're likely going to go up to this level over here. If we go below the lows over here, we're likely to drop lower. What we're going to do in the meantime, chop around. So that's how I view the charts. And then you don't really need to know anything else. You need to know what's happening with price. So that's all my decision making is based on that. Many years ago, I studied the fundamentals. I traded like that for maybe 3 or 4 years. Every day we used to go through balance sheets. We used to go through upgrades, downgrades, and I have a bit of a background in accountancy, so we were doing and working with forensic accountants as well. We could analyzing balance sheets of different companies and upgrades and downgrades. But when all came to the actual trading, it never really gave us an edge over anyone else. So my edge over the years is becoming an expert reading the charts in a simple way. And that's what gives me an edge and an ability to know whether I should be on the buy side or sell side, and the nimbleness, if you want to say, to be able to change my point of view in a flash as the market changes.
That's a great point, Simon. A good trader's got to be able to, shift their strategic mindset more or less in this type of market in the blink of an eye, because that's this stuff, as Fausto pointed out, low. A lot of, when I was in Chicago last week, it really is amateur hour on the desk. Everybody's either packed up, head to the Hamptons or out the Vale or the Islands, and you got 28-year-old kids who've never seen a down market. Literally, we have traders, approaching the upper 20s, managing big portfolios, and they've never even seen a down market. So it's very, very dangerous time to be trading. Let me tell you where I am here. Let's when you look at this chart of the S&P 500, when you see, and it's funny to call these things even pullbacks, but this one right here was the sell of the State of the Union. This one right here was the Republican clown car when they couldn't repeal Obamacare. They voted to repeal Obamacare 62, 63 times under Obama, but couldn't do it once under a Republican president. Stupidity. And then this pullback right here is the infamous Comey memo, which 24 hours later, the market decided that dude's either a liar or he's a liar. Take your choice. And we saw that last week. So the big pullbacks we've seen this year are more or less political or driven by Washington. So I agree with almost everything everybody said here, that we have to chop here until there's a catalyst either up or down. I mean, lost in all the Comey stuff last week was North Korea, folks, lighting off bottle rockets. We have a president who said Korea's not going to get away with this, and whatever his name is, Karima Sung-young guy, saying I'm keeping all my nukes and you guys can kiss my ass. So there's a potential black swan right there. We're also going to be getting this week some China data. We're going to get industrial production data from China, which in a slow news week can drive our markets. But I think Sessions' testimony tomorrow is going to be a non-event as well. So I think the politics are going to start. I think we're really the market's getting tired of the scandal an hour, and we're starting to. I think this when we snap back from the Comey memo implosion, I think we're starting to get tone deaf. So we are going to start looking more towards the Feds, right? And it's interesting because the Fed. One of the Wall Street isms I think we all grew up with was, when interest rates are high, stocks will die. When interest rates are low, stocks will grow. So whether it was Bernanke or Janet, wasn't on some press conference, Bernanke, or one of them said, "Oh, the biotech sector is way overheated." I'm like, when did you become a hedge fund manager? So they're obviously looking at the market and then cranking up interest rates. They're obviously taking a look at this chart, the S&P 500, and saying equities are, pretty far over their ski tips. But U.S. equities really are the best house in a pretty bad neighborhood. Where else are you going to go? You're not putting your money in a Folgers can, and I'm old enough to know what a Folgers can is, and put it out in the yard. So until there's more attractive assets out there, we grind higher and climb. I call it a hold your nose rally, man. I mean, this really is with one hand you're holding your nose, and with the other hand you're bidding it higher. And hopefully if you have three hands, with the third hand you're actually throwing on some volatility trades. Another Wall Streetism is when vol's cheap, you buy it. When it's expensive, you sell it. So, I have like a VXX bullish double vertical on just in case we have one of these Fred Sanford, it's the big one, Elizabeth. So I think we go higher, but there's a lot of potential macro events out there that could reach out and touch us. And there's world events, and there's also a lot of macro. But yeah, the Fed this week will be interesting, the retail data. But until it's incredible to the right of this chart, to the upside, I don't think any of us could fill in what would pull this market higher other than, the plunge protection team or earnings. But earnings are kind of soft. But we'd all agree to the downside of this chart is everything from a nuclear war in Korea to, European clown car to the Fed. There's a lot of more downside to this market, but you can't. Anybody who's tried to put a top on this thing is out of business. So a lot of things on the radar that I'm looking at least for this week. But like I said, at least short term tactically, I put on a weekly options bull put spread just because I think we are going to chop higher and climb this wall of worry. So anybody want to add anything after that before we go into question 4, or want to revise and extend their remarks, to use a political term, before we head on?
All good.
Okay, good. All right, so Kurt, why don't question number 4 that the folks threw on the survey there? What indicator influences your trading the most? I know savvy guy like yourself probably has 50 of them, but what would you say is your biggest?
I use just price. Looking at price through the candlesticks. So I personally wouldn't consider that an indicator. I consider that, more of what the indicators are going off of. And so having said that, I really don't use any indicators. I mean, I have like 2 moving averages, 8 and 21 day EMAs that I use to help guide the bias as far as, the direction of trend, where other traders are going to be looking. But to the degree that I use indicators, it's really just for purposes of knowing where others are going to be thinking and or reacting, and then putting that within the context of my plan and how I look to enter. So, for example, if I know that price is coming into what I would determine to be a buy zone based on my approach, and I also see that lines up with, say the 21 day, as well as a fib retracement. Not that I use the fibs, but visually you can look at a chart and say, okay, well, it's probably in this area. I can increase the odds of certainty by knowing I've got multiple areas of confluence that other traders are going to be acting at as well. Furthermore, I think that indicators, to the degree that they do influence you, it becomes an issue in the sense that you start looking for too much, right? You use this indicator, that indicator, this one as well, because somebody else is using it. And it starts to become a scenario where you're relying solely on the indicators and no longer based on what they are looking at to determine where, whether they're overbought, oversold, etc. So I think indicators really become more of a crutch than anything else, and something that is better moved away from ultimately.
Oops, mute button fiasco there. Fausto, how about you? What would you say out of all the things you look at, what influences you the most?
Well, being a day trader, most day traders don't really use specific indicators. We focus more just on supply and demand and price action. We look at the volume, more or less where the orders come in. So, one of the big things that we teach, and for some of you that have seen me, we have a whole, have seen me doing trades in our trading room, we'll work focus mainly on the high frequency trades, on the level 3, the total view, and there's specific stock or specific, industry that's moving pretty heavily. We just focus mainly on those items and just follow the orders, which will trickle down to what makes indicators move. Remember, indicators get a lot of their data from a lot of the time and sales movement of orders that are happening. So we're more of an aggressive, more of a quick trader, early in the morning, late in the afternoon. So it's kind of hard to use a specific indicator, moving average on it, because it is moving very, very rapidly early on. But the main indicator that we kind of use is just seeing where big institutions and market makers place their orders, program trading, and just kind of play within those range.
Awesome. Okay, John, how about yourself?
Yeah, wow, this is pretty easy for me, actually. I invented the Netto number, and the Netto number is a 3-dimensional way to assess the performance of any strategy, manager, asset class, or trade. And the reason why I use it and why I invented it is that a lot of indicators, a lot of charts are frankly one-dimensional. And the problem with that is that without the proper context of performance, you run into a lot of problems. So let me give you a real down and dirty example. I say that I want to give, I'll apply this at the asset allocation level, and why, the multi-trillion-dollar industry of asset allocation has some tremendous flaws in it. And the Netto number, along with the risk factor compensation system, can actually solve a lot of those problems. And here's what I mean by that. I can give manager A, all right, $1 million allocation, and I can tell him, okay, manager A, I'm going to give you a risk budget of $200,000 in that $1 million, okay? And guys like Fausto and yourself know from having proprietary trading experience, this is how a lot of proprietary allocations work, okay? And I can give manager B $1 million, and I can say, all right, manager B, you have a $400,000 risk budget based on some of the volatility targets of your portfolio. Well, at the end of the year, manager A made 10%, manager B made 10%, and the way that the most institutional tear sheets work to assess their performance, they would say, oh, well, manager A and B both made 10%. They both had the same performance. But that's not true, because manager A had half the flexibility. Manager A had half the risk budget that manager B had, all right? And so the Netto number actually measures on a 3-dimensional way not only the nominal performance, that 10% component I spoke about, but also the underlying volatility. And here's what's key. Hold it. The performance relative to the risk budget. Because the Sharpe ratio, the Sortino ratio, a lot of institutional ratios, we'll measure what's called risk-adjusted returns, where they take the performance in context of the volatility, which is better than just the nominal performance itself. But it's the Netto number that takes the performance in context of both the volatility and that predefined risk budget. So for me, I've taken the Netto number. Not only is something that could be allocated to assess a manager's skill, but I can now apply it. I've retooled it to assess the markets as well. And so for me, I come in and I have a dashboard, and I talk about this in chapter 5 of my book, how I apply this. A dashboard with the Netto number of every single ranking stock and market, and I can look at it and say, okay, today the Netto number of the S&P is actually higher than the Netto number of the Dow, all right? And that's not just based on nominal performance, that's based on those 3 factors I just mentioned. And so now when I look at a chart with fibs on there, which I love Fibonacci levels, I read Joe DiNapoli's book, Trading with DiNapoli Levels, which is one of the best books ever written, goes into all sorts of areas of confluence. I read that book 17 years ago when it came out. I still talk about it today. Joe wrote a chapter in my book. Now I have the context of the Netto number behind it. And that 3-dimensionality is why, and I have this verified, I took a $100,000 account and generated $3.1 million in P&L over 6 years with no correlation to the S&P whatsoever. All verified, all in my book by a third-party CPA. And it was that 3-dimensionality from the Netto number, from the macro narrative, from understanding market positioning, that gave me that edge. So, yeah, there you go. It's a Netto number.
Man, we teed that one up so you can put it out of the park. Very well done. I'd like to look into that.
It's about the opportunities you do when you get them, buddy. Right?
That's exactly right. Take those shots of opportunity. Simon, how about you? What's the biggest indicator that influences your trading the most?
Wow, that's a hard one to follow. That was great. Okay, I'm a pure price action guy, so I don't really use indicators at all. The only indicator I have on my charts is CCI. I don't really use it for I don't really use it for trading per se, but if I'm sometimes scalping on the smaller time frames, I use it to help me time my entries. And for trading like bases and certain strategies, I trade around bases. But apart from that, I'm pure price action. I identify areas of institutional buying and selling in the market as areas of supply and demand, and markets move between those zones, usually in trends. So I identify trends. I look at what direction the market's moving in multiple timeframes. And with that alone, with price alone, I come up with high probability trading scenarios that where the reward to risk, again, reward to risk is very important, where there's enough reward for whatever risk you're taking and the probabilities are in your favor. And that's how we build up our trading plan. I can give you an example of that on my chart if you want.
You know what, Simon, save that for our wrap-up question, because that might actually be a good segue with our final question. Yeah, absolutely. Let me. My answer is, of course, since I get to go last, I'm the host. I get to not ignore the question a little bit. The indicator I use the most is yes. I mean, there is no one. If you think, as a former Navy fighter guy, if any of you have seen an AWACS, you know, it looks like it's a big 707 older airliner. It looks like a UFO landed on top and is like trying to carry it away. That's a radar plane, and in the back of that is about 25 men and women looking at everything in the battle space, from, you know, monitoring some guy's cell phone to the control tower giving planes permission to take off, to electronic intelligence, to you name it. There's people in the back looking at everything in the battle space, and that's the way I trade. I look at volume, volatility, price action, the chart, politics, and you have to look at all of that together and holistically, because if you're just using one indicator, you're looking through a soda straw, in my opinion. So you have to incorporate everything. You know, if you're just looking at the chart, I know of no broker that lets you trade off of the left side of the chart, right? I mean, everybody knows looking at the left side of the chart's like driving around the Daytona 500 looking in your rearview mirror. So it's just not chart, it's just not volatility, it's not just volume, and it's just not you know, flow. For example, I think, Fausto, you're talking about some of the heavies. I know a lot of options traders that make a lot of the time a pretty good living just trading flow, right? Seeing, you know, Goldman Sachs comes in and buys 100,000, you know, Fred's Tire Store October, whatever calls. Well, guess what? You know, Goldman Sachs isn't an idiot, and they might know something. Kind of like the little fish that swim with a shark. Why don't we jump in that trade? Well, nowadays, you know, you're not open outcry. You're not in the pits. You don't see that happening. Sometimes these larger firms are actually placing trades to screw some of their buddies and do some counterintelligence. So it's you know, even trading flow can be a little bit misleading. So like I said, as a host, I get to go last, and I say all of them, and my answer is yes. So all right, guys, let's go ahead and go around the horn and do when I like to host, and it looks like we got some already. I like to pull a nugget out of you guys. Give us and all the listeners and the viewers here a good trade that you're either looking to put on, you currently have on, short term, long term, whatever it is. Kurt, what are you liking right now, and what would be a good parting trade for our folks?
You know, last time I was on, I was talking about TLT. That was about a week and a half ago or so, and that still looks set up well. You know, in light of all the conversations we've had, especially with the FOMC coming up. So I mean, that still looks good for a move higher. The other one I throw out there that I'm watching for right now is the Euro USD as a short. You know, it had a nice run up over the last several weeks, came into some congestion areas, and has since started to stall out. So like I said, I'm watching that for a short. So that would be one to definitely keep an eye on.
Yeah, makes sense. Fausto, I know you're a day trader, man, but do you have anything that you could throw out to our folks, potential good trade idea?
Oh, of course. I mean, listen, that's how we actually learn what we're going to swing trade. And one of them, and I've been talking for the last 6 months when I was on the last two times, Ferrari, race, RACY. I told everybody on here, you know, to buy it is a great buy. Company's trading at 33. It's got a P ratio of 33. Stock when we were here was at 50, it went almost to 93. A couple of, it's starting to back off now. I think a lot is due to a lot of profit taking going on right now. But listen, if you can't afford the car, you can at least afford the stock. And if you can't afford the stock, then and do a swing trade, then do an options trade, maybe a leap. But I can see the stock testing, maybe 150. Still going with those kind of earnings that's coming out with. So I'm still a big fan of that. I'm also a fan of CSQ. Company has a great PE ratio, plays a great dividend. It's another big stock that I've been looking at for a while. It won't go anywhere, as an overall stock in general, but as a fund though, I like those fund stocks that pay high dividends. And that's another big way of looking at it. I think those things are gonna get more popular as we move forward as an investment wise.
Yep, couldn't agree more, man. Especially as things get a lot more dangerous, people looking for yield, those dividend stocks, and usually they're a safer play as well. John, how about you? A good trade you could throw out for us?
Yeah, I think Craig was onto something with his TLT play. It's hard for me to imagine a scenario that the Fed doesn't say something that continues to grind higher in fixed income. We're seeing, when you want to make a bet on the TLT, it's not just about U.S. fixed income. It's what is taking place in Europe as well. And we've seen the OATs, which are the French fixed income market, do really well since the reconciliation of that election. Italian fixed income has done well, even though bonds have been steady. So we've seen this global migration towards fixed income. So I think the TLT play that he talked about makes a lot of sense, especially if the Fed. I mean, let's go over a couple scenarios for the Fed here. They come out, they're one and done. It's kind of what the market expects. We can go ahead and say, all right, fine. The longer the curve still continues to grind higher. The Fed comes out, they make a policy mistake. They give us the impression that they've hiked now, and they're going to hike at the end of the year as well. Well, guess what? Now they potentially inverted the yield curve, which is also in the longer term still good for that TLT for the long side. The Fed comes out and heaven forbid doesn't raise rates at all, and that TLT will be up $3 or $4. Okay, so when you break down the probabilities of that, there's a lot to go with in terms of 3 to 5 weeks down the road where that TLT can be. And when I handicap the scenarios and I look at what may be a perception that the economic slowness is not necessarily transitory, but it may be a little more structural because we're not quite getting the recovery. We'll see what happens this week with the retail sales and the CPI, and if we get anything from the Bank of England in terms of surprises, etc. But that being said, I think that's the way to go. And while I don't normally like to be at the tail end of money flows, because a lot of the CTA community out there has been buying up the 10 years and 30 years, if you look at the CFTC reports and some other anecdotal data. But I think we may be in like inning 3 or inning 4 of a 9-inning game, not necessarily in inning 8 of a 9-inning game. And for me, the TLT, maybe through some options, through some vertical option structures, has a lot of promise to the upside over the next 2, 3, 4, 5 weeks.
Awesome. Very well put, John and Simon. Good trade idea.
Okay, so this is a long-term idea. I don't know if you guys can see my charts again.
Yes.
And this is coming off this is the Australian dollar. And I mentioned it actually the last time I was on the show, and it looks like it's starting to set up. But this is a base, and I'm looking for this. If it holds this level and starts to push up, again, there's a few more things that we need to go into detail with that I can't cover on this show. But if we hold this level, then we're likely to break above this base, and we could potentially have a move right back up here, which is potentially a 2,000 pip move. So we're talking about a long-term trade up into these levels here on the Australian dollar, and it looks like it's starting to set up again. It's not a short term. Short term, we're kind of bearish at the moment, like as an intraday sort of, you can play on that, but I'm talking about on a long term. Now let me show you one more, and this is one from today actually. Was intraday bearish on the euro yen and actually entered the trade up here, and you see it's gone down to first target area was around 122.85. So this is an intraday. Again, it's not an idea for now, but if this continues going, we could drop down to this level. So it's still got, if it breaks this level, one thing that The direction here on the weekly chart is to the downside, although we are in kind of some demand area, but we could get a pullback. And I think this is also longer term bullish, but intermediate term, we may get a move down. If it breaks this level, we're going down to this next level below. So there's two trades. There's a short term, intermediate term trade, and the other trade was a long term, potentially setting up. It's not ready yet on the Australian dollar.
Hey, awesome, Simon. Thanks. Like I said, I usually, don't squeeze the trigger on a real trade if we're not pretty confident here. This is a bull put spread for the week. Like I said, I think we close at least higher from where we are today, and definitely above the 2015 level. A little softness out of the gate today, but it's a bull put spread 15 of the 24.15. I don't trade SPX, I trade SPY. And as a hedge to the downside in case the market implodes, it's the 24.10s. I have an SOP at Top Gun Options, standard operating procedures. I don't want to risk more than 5% of the model portfolio on any one trade. $100,000 model portfolio, that's about $5,000, a little north of that, but I'm okay. So potentially making $1,900 by Friday, and there's at least using at the money vol a 68% probability of at least breaking even. And this kind of fits my strategic mindset of, you see this ledge right here, there's your Comey snapback, and we kind of, everybody looked around and said, wow, we really are up here. Is this to be believed? And then we did all this stuff. If we're going to hold this, we're going to hold it. Well, that's brilliant. If we're going to hold this, we're going to hold this, meaning if we smash through this level right here with any airspeed, I think we're in for some pain. But I think we hold this, or at least chop around. That's why I love being an options trader. That trade makes money three ways. SPX goes up, we chop sideways, and the thing can even go down a little bit from where we are right now, as long as it stays above the break even. So that's my good trade idea for all the attendees here. And but you got to look at longer term XLK. I'd be looking to get into a Jan 19 long call diagonal on this pullback. Tech ain't going anywhere, folks. As we know, if we could hop in a time machine and go out to Jan 19, we're not going to be using wax tablets and carrier pigeons. It's tech will come back. We're seeing a little sector rotation out of tech into financials, and then vice versa. So I'd be looking at a Jan 19 potential trade there. So, all right, guys, that's it for me. So we got about 7 minutes left. So let's go to the top of the order. Kurt, why don't you let everybody know how they can get a hold of you or take a look at what you do at T3 Live.
Yeah, for sure. First of all, thanks for having me back on the show. Always a good time hearing what everybody has to say. As far as taking a look at what we have, you can go to T3Live.com. Got something for everybody, whether it be stocks, options, Forex, whatever the case may be. So you can check us out there, or just reach out to our customer service team, and they can get you set up with a free trial to any of the services you might see on the site that you're interested in. So again, thanks for having me, and look forward to being back soon.
Awesome, Kurt, you bet. And Fausto, how do we get a hold of you or take a look at your live trading room?
Sure, no problem. Thanks for having me again. It's always been a pleasure. I probably missed how many episodes have been on, but it's always fun coming back. And if you want to know more about Cybertrader University, just go to ctu.co, that's ctu.co, as a short version of Cybertrader University, and come and join us. And if you want to see some pre-market trading and see how we trade in the pre-market, because that's realistically where most day traders make most of their money. You get to see where all the mutual funds and hedge funds are hiding a lot of those dark pools. Feel free, we'll give you a workshop, and you'll be in the trading room, see what it's like and trade side by side with us. And if it's for you, it's for you. One thing I would like to recommend everyone in here, though, is that there's a lot of great speakers today, and I always say this to everybody. Every single one of us have a different niche, and everybody should know a little bit about Forex, day trading, swing trading, options trading. Find out what's best for you, but you should try a little bit of everyone's and see what works within your schedule, what you can understand, and go from there. So most important part about trading, but just don't be the self-taught individual, like I always say. Thanks for having me again, and thanks everyone.
You bet, Fausto. John, how do we get a hold of you and take a look at what you're doing?
Yeah, theproteintrader.com is my website. You can follow me on Twitter at John Netto, and my book, The Global Macro Edge, it's 600 pages. It is a weapon, not only physically, it's actually a blunt object, but it's also a weapon of information. 14 contributing authors to this book, and we're taking all the profits, and they are going to charities that place and train service dogs for military veterans coming back PTSD, depression, anxiety, all these things that impact our veterans. These dogs are a miracle. And every dollar we've made from this so far, we've donated to these charities and these organizations, and we're doing. It's great to see the results of that. And I would say follow me on Twitter at John Netto, JOHNNETTO. From there, you have all the links. You can get to my website, learn more about the book, and I'll see you guys on the Twitter sphere.
Awesome, John. Thanks for doing that, especially for the vets. Certainly appreciate it. And Simon, how about what do you do, my friend?
Okay, hi. You can see my screen again. It's easier to say that. So you can go to tradesmartforex.com. And over here, you can actually watch some free videos that I put out every week on Sunday. You can actually subscribe to my YouTube channel over here as well, and you'll get notified of those. They're put out every Sunday, and we go through the probabilities of where the dollar is likely to go next the following week or the coming week. You can sign up here if you want to be notified of any free webinars I'm giving. And soon we'll be launching our live trading room. So, if you're interested in that, you can send me an email to simon@tradesmartforex.com. And I'd like to thank you for having me and hosting me again on this show. And it's a great show. And thanks everyone who contributed to this one as well.
You bet, Simon. Thanks for coming in. Folks, if you want to learn more about what we do at Top Gun Options, it's perfect time, because tonight at 8 o'clock, I'm kicking off a full week of live trading and training. Me and my vol arb trader, Doug Robertson. You can head to go.topgunoptions.com/joinft. That's pretty easy to remember. Join full throttle. And the flight schedule for the week is actually on the page here. We're going to kick it off tonight at 8. Like I said, just kind of an in brief of what we do here at TGO, and then a primary live trade brief tomorrow, weekly options, retirement training, vertical spread training Wednesday night. It's just it's an incredible week. It's industry recognized as one of the best out there. And if you register, you'll get a free copy of our OPCL. That's the Options Pocket Checklist. I never went flying with the F-18 flight manual. It's a phone book. So what we do is we squeeze it down into a nice takeaway, and that's what the OPCL is. And then our 7-step trade plan, proprietary trade plan as well. So perfect time. You just need to head to go.topgunoptions.com/joinft, and I'll see you guys at 8 o'clock tonight if you're interested. So with that, I'll go ahead and hand it back to you, Dave. We got 2 minutes left, so we're on time and on target, my friend. So thanks for having me as host, and look forward to being back soon.
Yeah, thank you. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet. Also, you can go to TimingResearch.com to download any of the past reports or watch any of the past shows there. And join us next week. That'll be Monday, June 19th. Larry Gaines, Jim Kenny, and Dean Jenkins will be on. And I just want to thank all my guests again from this episode. Kurt Capra of T3Live.com, Fausto Pugliese of CyberTradingUniversity.com, John Netto of TheProteanTrader.com, Simon Klein of TradeSmartForex.com, and Matt Buckley of TopGunOptions.com. Thanks, everyone.
Awesome. Thanks, David.